Hare Krishna. Welcome to Tax Guru YouTube channel. This is CA Rohan R. Pingali, practicing chartered accountant based in Mumbai, also partner in Motilal and Associates LLP, member firm of Marks Network. Today, we are going to learn under video series GST Relearn Part 11, topic payment of tax. So let's start with it. Let me allow to share my screen. So today we are going to learn topic payment of tax under GST Relearn video series. So let's see what we are going to learn. Modes of payment of tax, electronic ledgers, utilization of input tax credit, interest on delayed payment, tax deducted at source, tax collected at source by e-commerce operators, transfer of input tax credit, payment in installments, relevant circular clarifications. That is three circulars we are going to learn. And at the end of the session, we will see conclusions that can be drawn from today's learning. So let's start with it. Payment of GST involves depositing tax via challan, maintaining ledgers, utilizing ITC in prescribed order. That is the how you can utilize ITC with first, second, and third. Like we have to use first IGST credit, then CGST credit, and then SGST credit. And complying with special provisions like TDS, TCS, and installments, proper compliance ensures what? Smooth credit flow and avoids interest or penalties. Proper compliance of this will ensure smooth credit flow and avoids interest or penalties, that is future litigations. So that is very important. Important part is payment of tax. So let's move on first. Modes of payment of tax. Relevant section is section 49 and rule 85 to 88D. GST is paid electronically through GST portal by generating challan in form GST PMT 06. Payment can be made via what are the modes of the payment? Internet banking, debit or credit card, UPI, NEFT, RTGS also can be done, and over the counter at authorized banks up to rupees 10,000 per challan per tax period. There is a limit for over the counter challans. Okay. What are the modes of the payment? Payment can be made via internet banking, debit card, credit card, UPI, NEFT, RTGS, and also over the counter, that is OTC, at authorized banks, and limit is up to rupees 10,000 per challan per tax period. Let's see practical example. Mr. A trader, has a GST liability of rupees 25,000 for July 2024. He generates a challan in PMT 06, selects NEFT, and pays via his bank. The amount is credited to his electronic cash ledger once the payment is successful. You also received a message from the GST department that the payment is successful and it is credited to your electronic cash ledger. Let's move on further. Electronic ledgers. Yes, is section 49, rule 85 to 87. GST uses three ledgers. Okay. Electronic liability register, that is PMT01. It shows total tax, interest, late fee, penalty payable, electronic liability register. There are three electronic ledgers. First is electronic liability register, which is also known as PMT01, and it shows what total tax, interest, late fee, penalty payable. Electronic credit ledger, that is PM2, PMT02, reflects what your input tax credit available. Electronic liability register shows total tax, interest, late fee or penalty payable. Electronic credit ledger, that is PMT02, shows or reflects input tax credit available to you. And third electronic ledger is your electronic cash ledger, that is PMT05, which shows cash deposits made and payments utilized via challenge. Okay, shows what cash deposits made and payments utilized. So there are three electronic ledgers: electronic liability register, PMT01, electronic credit ledger, PMT02, and electronic cash ledger, PMT05. Let's see practical example. ABC Private Limited has ITC balance of rupees 50,000 in PMT02, that is electronic credit ledger, and tax liability of rupees 70,000, that is in PMT01, that is electronic liability register. Okay. So they pay rupees 20,000 in cash because liability is 70,000, credit is 50,000, so rupees 20,000 need to be paid by cash. So they pay rupees 20,000 in cash, credited to PMT05, that is your electronic cash ledger, and from that you can utilize that payment and just rupees and adjust rupees 50,000 ITC from PMT02. Liability is cleared fully. Hope you are understanding. Next, third part, utilization of input tax credit. We have seen payments, the payment modes, four payment modes. Then we have seen three electronic ledgers, that is three parts of electronic ledgers. Now we are going further. Third part, that is utilization of input tax credit. Section 49A, 49B, and Rule 88. Let's see ITC utilization order. Yes, very much important. How we can use your ITC in the following order. First, IGST credit, then CGST credit, and then SGST and UTGST credit. So means IGST used first, then CGST and SGST. If you don't have IGST credit and CGST and SGST credit, then first CGST, then IGST, SGST, SGST, UTGST, and then IGST. The order would be like this. Cross utilization of CGST and SGST is not allowed. CGST cannot be used for SGST payment, and SGST credit cannot be used for CGST payment. So that is the cross utilization is not allowed of CGST and SGST among them. So order will be IGST credit, CGST credit, and SGST UTGST credit. Practical example. Let's see. Tax liability, IGST 40,000, CGST 30,000, SGST 30,000. ITC available, IGST 50,000. Okay, so first you have to use this credit. IGST liability cleared with IGST ITC directly 40,000 would be cleared from this credit. So you have to first adjust with this. Then balance IGST, that is rupees 10,000, used against CGST rupees 10,000. Completely, the final liability will be CGST 20,000 and SGST fully remained as it is 30,000 to be paid in cash or own ITC. Hope you understanding. Again, we will see what IGST liability is 40,000, CGST liability 30, and SGST 30,000. ITC available is IGST credit of 50,000. It is used fully to pay IGST 40,000. Then balance 10,000 used for CGST. So balance CGST 20,000 and complete SGST 30,000 is payable, which is need to be paid back in cash. Next part. Interest on delayed payment. Section 50 deals with interest on delayed payment. So it is 18% per annum on delayed payment of tax. That is 1.5% per month. 18% per annum on delayed payment of tax and 24% per annum if ITC wrongly availed and utilized. There are two rate of interest. One is general 18% per annum on delayed payment of your regular tax and 24% per annum if ITC wrongly availed and utilized. Let's see practical example. XYZ Limited had GST liability of rupees 1 lakh due on 20th August 2024 but paid on 10th September 2024. That is delay of 21 days. So interest will be calculated as rupees 1 lakh into 18% and for 21 days divided by 365 days is equal to rupees 1036. Very, very normal and easily calculated. Okay, so keep in mind what interest rate 18% and 24%. 18% for regular delayed payment of tax and 24% per annum is if ITC wrongly availed and utilized. Next, tax deducted at source. 11 section 51 and rule 66 applicable to government departments, public sector units and local authorities. This tax deducted at source is applicable to whom? Government departments, public sector units and local authorities. Rate is 2%, that is 1% CGST and 1% SGST, where contract value exceeds rupees 2.5 lakhs. This is applicable only to the government departments, public sector unit, local authorities. And we are dealing with this. Then only this TDS is applicable and the rate is 2%, that is 1% CGST and 1% SGST. And that is also if your contract value exceeds rupees 2.5 lakh. TDS is deposited by 10th of the next month and reflected in supplier's cash ledger. TDS is deposited by 10th of the next month and reflected in supplier's cash ledger. Let's see practical example. A government department awards a contract of rupees 5 lakh to PQR Limited. Then GST will be 18%, 19,000 and TDS will be 2% on rupees 5 lakh, that is rupees 10,000. Supplier gets 4,90,000 net payment and rupees 10,000 credited to his electronic cash ledger. So gross payment is 5 lakh minus GST minus TDS, 10,000. So net payment will be 4,90,000 will be received by supplier and rupees 10,000 credited to his electronic cash ledger, which can be used to payment the GST too. Next, tax collected at source by e-commerce operators, section 52, rule 67. E-commerce operators like Amazon, Flipkart must collect TCS at the rate of 1%, that is 0.5% CGST and 0.5% SGST on net value of taxable supplies made through their platform. So e-commerce operators like Amazon and Flipkart must collect what? TCS at the rate of 1%, 0.5% CGST and 0.5% SGST on what value? Net value of the taxable supplies made through their platform. Let's see practical examples so that you will be easily understand. A seller sells goods worth rupees 1 lakh through Amazon. TCS at the rate of 1%, that is rupees 1,000 deducted by Amazon. Amazon deposits this TCS with government and reflects in supplier's electronic cash ledger. Sellers receive 99,000 from Amazon. So a seller selling goods of worth rupees 1 lakh through Amazon platform. Amazon need to collect TCS at the rate of 1%, that is 1,000 deducted by Amazon, and Amazon will pay to the seller how much? 99,000 after deducting TCS. That is the seller receives rupees 99,000 from Amazon. And the deposit TCS with government and reflection suppliers electronic cash ledger to be utilized. Next, transfer of input tax credit, section 53 and 53A. How you can transfer your input tax credit? What is it? ITC can be transferred between distinct persons having same PAN but different GSTNs in prescribed manner. Section 53A allows that transfer of certain balances between electronic cash ledgers of distinct persons. Let's see practical example, so that we will be easily understood. Head office Delhi GST has excess IGST credit of rupees 5 lakhs, while branch Mumbai has IGST liability of rupees 4 lakhs. Then in that case, HO can transfer rupees 4 lakh ITC to branch via GST portal. Very, very good provision. So if you have credit in your HO or in another part, and you have to liability in your other distinct place, that is like if you have head office in Delhi, that is excess IGST credit 5 lakhs, which is not available to utilize, then you can use it to your branch in Mumbai if you have a IGST liability there of rupees 4 lakhs or whatever it may be. And you can transfer that 4 lakh ITC to the branch via GST portal. That is the transfer of input tax credit. So you can transfer between the your distinct persons. So means having the same PAN need to be there. Okay. Next, payment in installments, section 80, rule 158. You can pay, the commissioner may allow, only commissioner may allow payment of tax dues in maximum of 24 monthly installments. But interest at the rate of 18% applies, cannot be granted for self-assessed tax. Means it is applicable whenever you have any issues in the assessment. Then payments in installment, commissioner may allow payment of tax dues in maximum of 24 monthly installments, and that is interest at the rate of 18% applies. Let's see practical example. DF Limited faces GST demand. I can already told you that if you are facing any issues, then only you will be able to use this provision, that is payment in installment, and that is also in the hands of commissioner if he allows you. DF Limited faces what? GST demand of rupees 24 lakhs. So commissioner allows payment in 12 installments, monthly installments. So DF pays rupees 2 lakhs plus interest every month at the rate of 18% per annum. That will be applicable per month, whatever it may be. So, but this provision is not applicable or not granted for self-assessed tax. You need to pay your self-assessed tax completely. You cannot pay it installment in mode of installment. Please keep in mind. This payment of installment option only available whenever you are facing any issues, whenever you received any demand and the payment is, the liability is huge, then you can request to the commissioner, and commissioner allow you to pay it in installments, but at the rate of interest 18% per annum. So now we are moving to circular clarifications. We will discuss 3 relevant circulars related to payment of tax. So these are issued between 2017 to 2025. These circulars mainly provided what? Procedural clarity and relief to taxpayers in ITC utilization, refund, recredit, and annual compliance. Let's see circular number 98 issued in 2019, which clarified ITC utilization and order under section 49A and 49B. Introduced post amendments in section 49A and 49B effective 1st February 2019. Key clarifications are IGST credit must be fully utilized first before using CGST and CGST ITC. It is from that date this needs to be followed. This flow of pattern of utilizing the credit will be followed. That is, IGST credit must be fully utilized first before using CGST and SGST ITC. Taxpayers cannot choose utilization sequence at will. Statutory order must be strictly followed. The taxpayer cannot choose utilization sequence at his will. It must follow the statutory order. IGST credit can be used for IGST, CGST, SGST, or UTSG in that order, and cross utilization between CGST and SGST remains prohibited. So, what will be the impact of that? It reduced flexibility for taxpayer in cash flow management. So, because the taxpayer cannot utilize it in sequence at his will. Let's say example, if liability of IGST rupees 20,000, CGST 10,000 and SGST 10,000 and available ITC of IGST is rupees 15,000, CGST 10,000, then IGST ITC first set off against IGST liabilities, that is balance IGST liability made through CGST and SGST ITC or cash. Means in this case, your IGST 15,000 credit will be utilized to pay your IGST liability of 20,000. Then again, there will be a 5,000 liability. So your CGST credit of 10,000 will be paid, utilized for IGST of rupees 5,000, and then balance 5,000 will be adjusted against CGST. Then balance 5,000 and 10,000 would be paid in cash. Hope you have cleared. Okay. Circular 174 2022 introduced PMT03A for re-credit of ITC in cases of refund rejection. It introduced from GST PMT03A mechanism, and what are the key clarifications? Where refund of ITC claimed is rejected partly or fully, then re-credit can be done to taxpayer's electronic credit ledger. Applicable when refund is rejected for reasons like ineligibility of ITC or incorrect claim. Officer passes an order in RFD 0106 and simultaneously issues what? Recredit order in PMT 03. Taxpayer can restore ITC in future returns. The impact was it avoids permanent loss of ITC due to technical mismatches or incorrect claims. Very relevant. Avoids what? Permanent loss of ITC due to technical mismatches or incorrect claims. Whenever refund get rejected, you can use that ITC by using this procedure. Example, refund claim of rupees 1 lakh ITC rejected to the extent of rupees 20,000 partly or fully. So officer recredits rupees 20,000 back to the credit ledger via PMT03 so that assessee cannot lose that credit. Okay. Next, third circular, circular 246 of 2025, very latest circular, clarified treatment is of late fee of for GST R9C delays. Issued to resolve ambiguity regarding late fee applicability for Form GST R9C, that is the reconciliation statement. And what key clarifications are in this circular? So late fee under section 47 subsection 2 is applicable only to annual return in GSTR 9 and not to GSTR 9C. Delay in filing GSTR 9C may attract penalty under section 125, that is general penalty, but no specific late fee prescribed. CBIC clarified that taxpayers cannot be asked to pay late fee for delay in GSTR 9C beyond the statutory provisions. What it clarifies is that the taxpayers cannot be asked to pay late fee for delay in GSTR 9C beyond the statutory provisions. So what was the impact? Relief to taxpayers as demands for late fees on delayed GSTR 9C filing were being raised by the officers, and now due to this clarification, it will be now stopped. So let's see the example. If a company files 9C for 22-23 on 30th December 2024, instead of due date 31st December 2023, no late fee under section 47 applies. Only general penalty may apply if initiated. Okay, hope you are clear. So now we are moving at the end of the session, that is conclusions that can be drawn from the today's learning. It will help you to recollect what we have discussed and what we have done. So let's see conclusions. GST operates on digital payment system, that is all payments of tax, interest, penalty, late fee or fees and other dues must be made electronic using challans and electronic ledgers. Three types of electronic ledgers. This ensures what? Transparency, reduces cash handling, and facilitates real-time credit to the government accounts. Electronic ledgers provide what? Structured accounting. Electronic ledgers provide what? Structured accounting. That is a liability register, credit register, credit ledger, and cash ledger act as a self-reconciling mechanism. They prevent what? Double accounting and ensure what? Clear visibility of dues, credits, and payments. Very important. These ledgers ensures what? Clear visibility of whatever dues you have, credits you have, and payment. There is no manual intervention at all. ITC utilization follows a strict statutory order. After amendments in Section 49A and 49B, taxpayers cannot freely choose set of sequence. IGST, ITC must be utilized first, followed by CGST and SGST in a defined manner, and this ensures what? Uniformity and protects the government revenue. Timely payment is crucial to avoid interest and penalties in future. So interest at 18% applies on delayed payment and 24% on wrongful ITC utilization. Even minor delays lead to financial cost and reinforcing the importance of compliance discipline. So you need to be compliant on your own with a proper timeline. Special provisions like TDS and TCS when the tax base, widen the tax base. So government wants to widen the tax base and uh, collect revenue as much as it can possible through this way. So TDS by government entities and TCS by e-commerce operators create what? Additional checkpoints. This helps plug revenue leakages and ensures what? Better compliance from suppliers. Flexibility exists through ITC or cash transfer and installments. Of course, Section 53, 53, and 80 provides what? Mechanism to transfer balance between the distinct persons and to pay dues in installments. This balance compliance enforcement with taxpayer convenience. Very, very important provision. Refund recredit, that is PMT03, avoids what? Permanent loss of ITC. This is also very important. The Circular 174 2022 ensures rejected refund claims do not block working capital of the business processing of the business needs. This strengthens the taxpayer trust in the GST framework. Clarifications on annual compliance to reduce disputes. Circular 246 2025 clarified that the late fee is not leviable on GSTR 9C. This prevents unnecessary demands and provides what? Certainty to the taxpayers. Overall system aims at what? Revenue protection with taxpayer facilitation. Okay, it protect the revenue of the government as well as it facilitates the taxpayer in sayings, while GST law enforces strict order of utilization and interest on defaults, it also provides relief through recredit, installment option, and clear circulars. The balance between enforcement and ease of doing business is core feature of this. So this we have learned today. Hope you are learning through this GST Relearn video series. We are covering the topics from basics to advanced level. Be touch, be subscribe Tax Guru YouTube channel if you are not yet subscribed to learn these topics, and regular updates is also on Tax Guru YouTube channel on various subjects and on various topics. So be there. Hope you are learning, and we all are learners. So let's, if you are like this video, if you think that it is very useful, then do share. A small share will spread the knowledge and learning with mass people. Hope we will learning at the best of the best. Thank you so much for patient hearing and learning. Let's meet in a next video soon. Till then, bye bye. Take care. Hare Krishna.